I think let's start off by putting things into context with regards to your thoughts on what's happening in Europe and the US. Are you worried? Are you positioning yourself relative to the risks that are occurring on a global level, or are you still looking at fundamental factors and whether stocks are offering value or not?
Are we worried? I don't think so much worried as maybe a bit anxious. You know, the goings on around the world are getting everyone very sweaty palmed, understandably. But I think the second part of your question is very important. Are we focusing on fundamentals? And the short answer is yes. I saw a very interesting quote, or I thought it was interesting, from the head of the Kuwaiti Investment Authority 5 or 6 weeks ago. And he said something along the lines of, we used to make investment decisions based on economic fundamentals. Now we have to make investment decisions based on reactions of politicians. And I think, you know, as much as that is a very specific comment from one investor, it's symptomatic of what the world is like at the moment. We're going from headline to headline. Is Greece going to fail or not? What's happening in Spain and Italy and Berlusconi, and he's stepping down, and from
so
these
you are
headlines,
keeping tabs on the daily noise then, I see.
Well, it's hard to miss it. But I think the key is, if you are in the game of speculating, this is a very interesting time to invest. There's a lot to speculate on. If you're in the game of investing, which is probably a more sane and sober approach to managing money, then you do want to look at fundamentals now more than ever. And I would couple that with continuing to look at meaningful investment periods. So 3-5 years. Anything less than that, you may or may not get caught by the vagaries of the market sentiment.
What do you feel in terms of there's a lot of speculation about a low return environment going forward, because you've got these very low yields on anything that looks like good quality paper and even good quality shares. You've got a very low yield. So what's that low yield doing to your long-term projections of return for your clients?
Yeah, the low return environment is very difficult, because what we all need to do as investors, whether it's the investment manager or the end client, is adjust our expectations down. Now, none of us like to do that when it comes to our investment returns. We all want to adjust them up, not down. And so at first glance, that's very difficult. What you need to do, though, is, if that's the environment in which you play, there's very little that you and I can actually do about that, other than to try and manage around it. Now, you make the comment that a number of high-quality shares have actually seen yields come down, and I think while that is true in places, in fact, there are some very high-yield, good quality companies around the world. And what we see playing out is, in places of high economic stress, so Greece, Italy, Germany, you're seeing assets priced very low, but they are still decent businesses with economic or business operations outside of those regions. So that's quite interesting to us. I don't think it's all doom and gloom, but certainly you need to, again, come back to the fundamentals. What is a sound business, strong balance sheet, where's the earnings coming from, and build your investment case around that.
Let's look at your flexible fund. Size 149 million rand, and fund inception the 1st of July 2011. Tell us a little bit about why you started it on the 1st of July this year, in the midst of all the volatility.
Send it into the fire. I must just say, while the fund itself launched at that date, we've been running the strategy for institutional clients for more than 2 years now. But yeah, so the date of launch is nothing more than coincidence. The thinking behind the fund...
But new money was allocated at that time?
Yes, we did. Yeah, so that's when the money was coming in. We had little control over it. So baptism by fire. Good. But incidentally, what we're trying to do with the fund strategy, and the timing was interesting because it gave us a very nice opportunity to demonstrate the flexibility, as the name implies, of the fund, is over time we expect that this portfolio will beat equities, and over time I'm talking more than 3 years. This is not by December this year. The fund is very price sensitive in how it makes allocations into or out of equities.
So look at the asset allocation, 75% into equities right now, 25% in cash. Your benchmark is 50% equities, 50% JSE All-Share, 50% cash.
Right.
A combination of the two, right.
That's right. So the way the fund works, if I go back a step, being flexible, we want to be really flexible. I think there are lots of flexible funds around by name which move in small increments, and this is really quite an aggressive tilting fund. So to put it into perspective, we can hold as little as 0% in equities and as much as 100, and we will move in increments of 25%. Now, in industry terms, those are pretty big leaps. We started the fund in July, as you've mentioned, with a 50-50 allocation. What you can infer from that is that our observation about market valuation is that it was neither expensive nor cheap, hence we were equally allocated to the two. Now, the comment I made about the inception date being a useful opportunity to demonstrate the flexibility of the fund is, if you recall, the beginning of August. At the time we went into August with this 50-50 allocation, and the sharp fall off in the market in the early parts of that month improved or decreased, depending if you're optimistic or cynical, the valuation of equities. The price sensitivity of the fund caused us to increase that equity exposure from 50 to 75, which emotionally was quite a tough call at the time, if you cast your mind back 8 weeks. But what it allowed us to do was participate in the recovery, because as much as August had that massive sell-off, it rebounded, and for the rest of the month, the market was actually flat.
Because what do you think the flexibility is?
I think that it's a very brave fund to launch, in the sense that you're predicting equities is nearly as in the short term, is nearly as difficult as predicting currencies, I guess. So most managers will actually say, I've got a long-term allocation to equities and I don't really change that all much. So you really have to feel that you've got some way of determining whether markets are cheap or expensive, even with a relatively short horizon.
Cyclically adjusted price to earnings.
Exactly.
Right?
So there's a couple of very important points. The most important is this is not about predicting when equities will do well or poorly. We run the portfolio entirely on a backward-looking basis, which is very important, because for us to sit here and say equities will deliver X, therefore I'm going to invest Y, as you say, it's as hard as currency.
Okay.
I think it's easier than currencies, but it's very hard.
Okay, top holdings. We run almost out of time.
Okay.
Anglo-American, Sasol, Old Mutual, African Rainbow Minerals, Exaro, ACI, MMI, Pinnacle, Technology, Steinhoff and Grindrod.
Yes.
Well diversified, mostly shifted towards resources, but and industrials.
Yeah. So once we've made our allocation to equities, we then run the Canon Asset Managers equity process. What you'll find is the concentration in the portfolio is quite high. So we hold far fewer shares than most equity funds would. And the weight given to each share is relatively high, so a minimum of 3%. You mentioned a skew to resources. I think that's a little bit misleading, just by virtue of the fact that the resources we hold generally at this stage are quite big, so they find their way into our top 10. But in terms of our exposure to resources, we are marginally overweight, but it is just by a small amount.
Fantastic. We have to leave it there. Andrew, thank you so very much for joining us.
Eleni.
Great to have you on the program. Andrew Newell, Canon Asset Managers.